On Friday, the jobs data came out and it was bad. Kind of no other way to put it. Quite a pathetic jobs number on Friday for the non-farm payrolls, plus 22,000. Expectation was already low at 75,000. We came in 53,000 lower than expectations. Look, it looks bleak, at least from a jobs front, with regards to where we're at in this macro cycle. Then we need to kind of think through what is the implication here? How should we really be reading this? Is this a sign of a major slowdown on the way, or is there another explanation that makes a little bit more sense given all the data, this idea that we're still in this kind of post-supply shock corridor and what's going to be out the other end after we get past this slowdown? That's what I want to talk about. Make sure you get subscribed to that notification bell on if you are new here. And if you find this video particularly helpful, give it a thumbs up on the way out. All right, let's get into it. I saw quite a lot of commentary on this. Obviously, the perma bears see this as justification for everything that they have been saying for the last 5 years. The way I like to kind of break this down, whenever I see any data point, is just think about the main drivers and then the main drivers of that data point. So what are the main drivers of the macroeconomy as a whole? And then if we're looking at a subsection of some sort of kind of downstream data, such as what jobs are, those are pretty high up on the tier list of importance. What are the main drivers of that? And then what are some things that we would expect to be happening along with that data shift if it's painting a bearish or bullish picture, and then vice versa? What are things that we wouldn't be expecting to happen given what the picture the data is painting? So let's do this. Ultimately, I guess I'll just lead with the story itself. Look, I think we are still likely in this kind of post-supply shock zone, and that very, very soon we're going to find our way on the other side, now that kind of the volatility of what is the Trump administration doing going to settle. And as we've been talking about on this channel, that the tariffs themselves, the main cause of this pause in terms of hiring, in terms of just decision-making at the top level, might just be resolved by the Supreme Court. That I think we're going to see ourselves on the flip side of the supply shock. And so where it was a pause on business activity, it's now going to be a choke point demand, very similar to the post-COVID era, where we're going to get a big end of cycle surge. That's where I think we're at. But let's kind of debunk is this a sign of a major slowdown, or what else would we expect at a major slowdown, and how this really points to, again, the very tail end of the effects of the supply shock that we saw post-Liberation Day to where we're at today. So the first thing is, let's actually talk quickly about the last item here on the list. And again, we're focusing right now on the signs of a major slowdown. And the first item is going to be credit and fiscal. We talk about that quite a lot on this channel, over on Twitter during the live streams and whatnot. And the short argument here is that yes, fiscal has been slowing in a year-over-year basis from a deceleration standpoint, but we're far from collapsing fiscal at this point. I would still put us in this kind of near bubble, slight bubble territory where we're no longer getting additional growth from fiscal, but we've certainly been seeing the credit cycle take off, as we have been expecting for quite some time. And I see a still healthy business cycle from that vantage point. So we're not going to dive too much into the data there. We've done so in recent videos, but where I do want to look is with two other ideas and get into a little bit of theory. The first one is inflation when it comes to a major slowdown. One of the things, especially on Twitter, I've been pretty vocal about recently is it's very difficult, and I think I went into this as well on the most recent live stream, it's very difficult to get an end of cycle scenario to play out without an acceleration of inflation. And the reason for this is it is a sign that the major components, the major input components to the cost of the production cycle being wages. And as wages push higher, you get this surge in inflation. And that oftentimes coincides with a tight labor market that is pushing that inflation up. And that kills the business cycle. When inflation is falling, that means costs are generally going lower. And certainly since we've been seeing strong strong fiscal for the past few years, now transitioning into strong credit, that means that we're seeing a lot of productive output come out of the macroeconomy because we see it in the fact that inflation has been falling for quite some time. And so when I look at the slowdown in non-farm payrolls and you coincide that with where inflation is at, I'm just not seeing that big end of cycle inflation pop that you would expect to coincide with payrolls starting to falter here. Now, if we saw this exact same scenario play out and inflation had been rising for quite some time, then I would be a little bit more worried. But that's not what we're seeing. In fact, we're seeing quite the opposite. And so the next thing that I would want to take a look at is, okay, that's fine. Maybe inflation isn't showing the picture, but hey, Doug, maybe we don't need inflation in this cycle. Maybe the shock is just powerful enough that it's just going to send us right into recession immediately, and that we're seeing just a complete slowdown and we just never needed the inflationary shock. Well, the next thing then that I would want to take a look at is, what do job losses look like? Because it's not so much are we seeing hiring slow down, are we seeing the amount of employed slow down, but are we seeing people actually get fired? And this is where, or layoffs happening and that sort of thing. And this is really where I think this is some sort of sign of a major slowdown really falters. And if anything, again, just kind of points to this temporary timeout that the private sector took following the Liberation Day, and that we're just not seeing the full conclusion of that yet because there still is kind of this uncertainty that's out there. And so if we look at data such as job losses as a percent of unemployed, we just don't see what you would expect heading into a recession. Heading into a recession, every time you get a sudden collapse in that job loss as a percent of unemployed, and then a sudden spike. So as the business cycle is accelerating towards its end, the collapse occurs in job losses. There's just not layoffs. There's not firings that are happening. And then all of a sudden, on a dime, the trend turns and you get a massive acceleration for a handful of months into a recession. And that pattern repeats itself into every single recession. Well, we are still on the downswing. Now, maybe it's stopping this month, but as it stands right now, we have not seen that kind of multi-month acceleration where layoffs, firings, that sort of thing have to happen. And what you can glean from that is that this sort of job loss, right? So if we're seeing unemployment go up because people are getting fired or laid off, that means costs are actively being cut, right? Companies are straining. Well, in this instance, we're seeing this flattening of non-farm payrolls. Well, we're not seeing any layoffs, which just means a better explanation has to be out there than a major slowdown. And I still think that that better explanation of all the data that we're seeing is, in fact, this idea that we are still in the kind of corridor of the post-supply shock era of the tariffs, and that it takes time for more certainty to build before more investment can happen. And part of the reason why I think it will happen is because we have seen this sudden rise in credit. Just like when COVID hit, there was an immediate drawing on the credit lines from the private sector. We're seeing that exact same thing happen. And when that happens, when you get a sudden surge in credit, even if it's for strenuous times, even if it's for uncertain times, that still is creating new money, which is creating support to buy the output, which is creating new economic activity to support the overall asset price of markets. That whole game continues on, and now that money is out there, and then all of a sudden the uncertainty becomes more certainty, and the volatility of what's going to happen subsides, and that's when you get that sort of snapback movements that happen in the macroeconomy. I think that's exactly what we're seeing, and I think we're very close to the end of that cycle where we're going to snap back, and we're going to see the acceleration back to the other side, where we will ultimately get more inflation, where at one point we will actually see job losses start to tick up as inflation ticks up, and then we will get closer to the end of the cycle. But I just don't see us at that point in time right now, which is why I think ultimately the better explanation here is this idea that we did have a major tariff tariff-induced supply shock. We're going to come back on board here in full force. We're going to see the end of this cycle get highly speculative. We're going to see the sort of inflation show up very soon. Heck, we could even see this Friday, I think CPI is expected to come in higher than last month to begin with. Maybe we start getting the surprises to the upside. That's when you get to the end of the cycle, and that takes 6 months, a year to really play out, to really start to become a deteriorating factor in the overall business cycle. So that's where I see us currently, and I think a better explanation of the data that we are seeing with regards to the jobs data that came out on Friday. Before I let you go, though, if you are an active investor, active trader, make sure you head on over to appliedmmt.com, sign up for that pro account. Just put today's update up earlier this afternoon. Go into a lot of detail on the rest of the macro economy with regards to various asset classes, bonds, gold, the rest of it, emerging markets. Talk a lot about where we're at from a broader perspective. So head on over there if you like this sort of research and analysis, and you need this sort of insight on a more consistent basis. AppliedMMT.com, all the tools, all the data dashboards, all at your fingertips, the models, the forecast models, all over there. AppliedMMT.com. Again, active traders, active investors, sign up. With that being said, that's all I've got for today. So until next time, good trading, follow the flows. We'll talk to you next time. Bye-bye.